In the beginning, there was trade. Long before the advent of currency, ancient civilizations relied on the barter system to exchange goods and services. Imagine a bustling marketplace where farmers, artisans and traders met to swap their wares, grain for pottery, livestock for textiles. This system of direct exchange was the foundation of early economies, a simple yet effective way to fulfill the needs of communities. But as societies grew more complex, so did their economic interactions. The limitations of barter became apparent. What if you had something valuable but couldn't find someone who wanted it? Or if the person who had what you needed didn't want what you had to offer? The inefficiencies of barter led to the creation of more sophisticated forms of trade, laying the groundwork for the development of credit. Join us as we embark on a journey through time, exploring how human ingenuity transformed the simple act of trading into the intricate financial systems we rely on today. This is the story of consumer credit, a journey that begins with the humble origins of trade and barter. The video is for educational and entertainment purposes only. It is not financial advice. Consumer credit. It's the bedrock of modern economies, the invisible hand that drives spending and shapes our financial lives. From everyday purchases to major life investments, credit is the oil that keeps the gears of commerce turning. But have you ever stopped to consider where this powerful financial tool originated? How did we go from bartering for goods to swiping plastic cards with ease? The story of consumer credit is a fascinating journey through history, a testament to human ingenuity and our evolving relationship with money. Join us as we delve into the captivating history of consumer credit, exploring its profound impact on economies, societies, and individual financial behaviors. While bartering laid the groundwork for early trade, the concept of credit emerged as societies grew more complex. In ancient Egypt, credit was used to finance agricultural activities. Farmers borrowed seeds and tools, promising a portion of their future harvests in return. This system allowed for more efficient resource allocation and helped stabilize food supplies. Similarly, in ancient Greece, credit was essential for maritime trade. Merchants often borrowed to finance their voyages, repaying loans with interest upon their return with goods from distant lands. These early credit systems were built on trust and reputation, laying the foundation for more formalized financial practices. As we move forward in our exploration, we'll see how these early uses of credit evolved and spread, influencing civilizations across the globe. Before the advent of currency, humans relied on bartering, the direct exchange of goods and services to fulfill their needs. This system had inherent limitations. Finding someone with a desired item who also needed what you offered proved challenging. Necessity led to the development of early credit systems. Mesopotamia provides the earliest recorded evidence of credit transactions. Clay tablets dating back to 3500 BC reveal a sophisticated system of loans. Ancient Rome further refined credit practices. Credit facilitated trade within the vast Roman Empire. The seeds of modern consumer credit were sown millennia ago. The heart of ancient Mesopotamia, nestled between the Tigris and Euphrates rivers, pulsed with the energy of commerce. Here, in the cradle of civilization, the concept of credit took its first tentative steps. Imagine bustling marketplaces, the air thick with the aroma of spices and the cacophony of bartering. While goods were often exchanged directly, a more sophisticated system was emerging, one built on trust and the promise of future payment. These early credit transactions were meticulously recorded on clay tablets, durable enough to withstand the test of time. The Code of Hammurabi, one of the earliest known legal codes dating back to 1750 BC, even included provisions regulating interest rates and debt repayment. While rudimentary compared to modern systems, these early practices laid the groundwork for the evolution of credit as a fundamental economic instrument. As the Roman Republic rose to prominence, its legal and economic systems grew increasingly sophisticated, and with them, the role of credit expanded significantly. Roman law recognized different types of loans, each with its own set of regulations and obligations. There were loans for specific purposes, such as financing business ventures or purchasing land, as well as more general loans to cover personal expenses. The growth of the Roman Empire, with its vast trade network spanning across Europe, Asia, and Africa fueled the demand for credit. Merchants relied on credit to finance the transport of goods over long distances, while wealthy patrons used it to invest in lucrative ventures. The Roman government itself even utilized credit to fund public works projects and military campaigns. The Roman Senate, recognizing the importance of credit in maintaining economic stability, established institutions like the Argentarii, who acted as bankers and moneylenders. These early financial intermediaries played a crucial role in facilitating credit transactions, assessing creditworthiness, and managing the flow of capital within the Roman economy. However, the Roman credit system, like its Mesopotamian predecessor, was not immune to abuse. Exorbitant interest rates and predatory lending practices often trapped the poor and vulnerable in cycles of debt. These issues occasionally led to social unrest, highlighting the need for regulations to protect borrowers and ensure the responsible use of credit. Despite these challenges, the Roman Republic's contributions to the evolution of credit were significant, laying the groundwork for the development of more complex financial systems in the centuries to come. Medieval credit and the seeds of change. The fall of the Roman Empire ushered in a period of significant change in Europe. The once thriving trade routes declined, and the centralized Roman economy fragmented into smaller, localized systems. While credit did not disappear entirely, it took on different forms during the Middle Ages. The Catholic Church, a dominant force in medieval Europe, played a complex role in shaping credit practices. Usury, the lending of money at exorbitant interest rates, was condemned as a sin. Despite these restrictions, credit continued to flow through alternative channels. The development of banking houses in Italian city-states like Florence and Venice marked a turning point. The dawn of the 1800s witnessed a dramatic shift in the economic landscape of Europe and North America. The Industrial Revolution spurred unprecedented urbanization. Cities swelled with people seeking opportunities in this new era of mass production. This urban growth fueled the rise of a new class, the merchants. Department stores emerged as temples of consumerism. They offered an array of goods under one roof, catering to the desires of the urban middle class. But these emporiums faced a challenge: how to make their merchandise accessible to a wider customer base. The answer lay in store credit. Customers embraced this opportunity to acquire desired goods without the immediate burden of full payment. This system planted the seeds of a consumer culture where instant gratification, fueled by credit, became intertwined with social status and aspiration. As the 19th century progressed, store credit evolved beyond informal arrangements. The introduction of installment plans, a more structured form of consumer financing, further fueled the growth of consumer credit. Customers could purchase big-ticket items such as furniture and sewing machines by making regular payments over time. This innovation was a game-changer for both consumers and businesses. For the growing middle class, installment plans made previously unattainable goods seem within reach. The allure of owning a symbol of status and modernity, even if purchased on credit, proved a powerful motivator. It fueled a desire for upward mobility and a belief that material possessions were attainable through careful financial planning. From a business perspective, installment plans opened up new avenues for growth. They allowed businesses to tap into a wider customer base, those who aspired to own their products but couldn't afford to pay the full price up front. This led to increased production, job creation, and overall economic expansion. Shaping consumer behavior. The proliferation of store credit and installment plans in the late 1800s and early 1900s had a profound impact on consumer behavior. For generations accustomed to a more frugal way of life, where purchases were made primarily with cash, the allure of instant gratification through credit was transformative. The ability to acquire goods and services without immediate payment changed the relationship between consumers and businesses. It fostered a sense of empowerment, allowing consumers to make purchasing decisions based on desire rather than strict financial limitations. This shift, however, also introduced a new set of challenges and considerations. The concept of debt, once primarily associated with agricultural loans or business ventures, became increasingly intertwined with everyday life. Managing credit responsibly and balancing the desire for immediate gratification with long-term financial well-being became essential skills. The rise of consumer credit also fueled the growth of advertising and marketing. Businesses developed sophisticated advertising campaigns designed to stimulate desire and create a sense of need for their products. The seeds of modern consumer culture, with its emphasis on aspiration and material possessions, were sown during this era. As the 20th century unfolded, the seeds of consumer credit began to sprout into new and innovative forms. Department stores, now pillars of the retail landscape, sought ways to streamline transactions and enhance customer loyalty. This led to the emergence of the charge plate, a precursor to the modern credit card. Imagine a shopper in the 1930s, elegantly dressed, browsing a grand department store. Instead of fumbling for cash, they present a small metal plate embossed with their name and account information. This simple act represented a significant leap forward in consumer credit. Charge plates, typically made of metal or celluloid, were issued by individual retailers to their established customers. This system eliminated the need for carrying large sums of cash, offering convenience for both consumers and merchants. This transition paved the way for the development of credit cards, which would gain widespread acceptance. In 1949, a New York businessman named Frank McNamara found himself in a predicament familiar to many, dining out and realizing he'd left his wallet at home. This seemingly trivial incident sparked an idea that would forever alter the landscape of consumer credit. McNamara envisioned a world where individuals could enjoy the convenience of dining out without the need for cash, a concept that would eventually give birth to the Diners Club card, widely regarded as the first modern credit card. McNamara, along with his business partner Ralph Schneider, launched Diners Club in 1950. Initially conceived as a charge card for dining and entertainment expenses, Diners Club allowed members to charge meals at a select group of restaurants in New York City. The card, a simple cardboard rectangle, represented a radical departure from the retailer-specific charge plates of the time. Diners Club's success was swift and significant. The card's popularity quickly spread beyond its initial network of New York restaurants, expanding to other major cities and encompassing a wider range of merchants, including hotels, airlines, and car rental agencies, paving the path to modern credit. The success of Diners Club did not go unnoticed. It sparked a wave of innovation in the financial services industry, leading to the emergence of other charge card companies. These early charge cards introduced new features and expanded the reach of consumer credit. American Express, initially a freight and travel company, entered the charge card arena in 1958. American Express cards soon became synonymous with prestige and global acceptance. These early charge cards normalized the concept of using a card to make purchases on credit, paving the way for the mass adoption of credit cards in the decades to come. The bank credit card revolution. The charge card had disrupted the consumer credit landscape, but its reach was limited. The true revolution began with banks, not specialized credit companies. In 1958, Bank of America launched the Bank Americard, later Visa, a watershed moment. This was a revolving credit card, not just another charge card. Users could carry a balance, reshaping spending habits. Bank Americard's rollout involved unsolicited cards, initially met with skepticism. The convenience and merchant acceptance fueled rapid adoption. A consortium of banks formed MasterCharge, later MasterCard, expanding credit card reach, shaping the industry. The explosive growth of the credit card industry in the 1960s and 70s, while revolutionary, was not without its growing pains. Concerns over unfair lending practices and the potential for consumer debt to spiral out of control caught the attention of lawmakers. The Equal Credit Opportunity Act of 1974 marked a significant turning point. This landmark legislation outlawed discrimination based on gender, race, marital status, or other protected characteristics in the granting of credit. It opened doors for millions, particularly women and minorities, previously denied access to credit based on societal biases. The credit card industry, now operating within a clearer regulatory framework, continued to innovate. The introduction of affinity cards, co-branded with airlines, hotels, and other organizations, further incentivized card usage with rewards programs and perks. Credit cards in the information age. The late 20th century ushered in an era of unprecedented technological advancement, and the credit card industry, once reliant on paper statements and manual processing, was about to undergo a digital transformation. The Internet, a fledgling network in its early days, would soon revolutionize the way we interact with money, and credit cards were at the forefront of this revolution. The rise of e-commerce in the 1990s presented both a challenge and an opportunity for the credit card industry. Securing online transactions became paramount, leading to the development of encryption protocols and secure payment gateways. The convenience of online shopping, coupled with the ease of credit card payments, fueled the exponential growth of e-commerce, forever changing consumer behavior. The journey from ancient Mesopotamian clay tablets to today's mobile wallets shows the enduring power of credit. What began as a simple trust-based agreement has evolved into a global system underpinning trillions in transactions daily. The evolution of consumer credit is intertwined with human progress. It reflects our desire to improve our lives and well-being. Credit has fueled entrepreneurial endeavors, economic growth, and innovation. From the merchant class in the 1800s to modern online shopping, credit's impact is undeniable. Yet it's also a cautionary tale about responsible lending and borrowing. Mismanaged credit can lead to financial hardship, reminding us to wield it with care. The double-edged sword of consumer credit. The proliferation of credit cards has reshaped our financial habits and relationship with consumption. Instant gratification from credit cards can mask long-term debt consequences. High interest rates and the psychological burden of debt can turn manageable purchases into financial burdens. Responsible credit use can empower financial well-being and support long-term goals. Navigating the frontiers of finance. As we stand at the cusp of a new era in finance, shaped by rapidly evolving technologies and a growing awareness of the need for financial inclusion, the future of consumer credit promises to be as dynamic and transformative as its historical journey. The digital revolution is poised to reshape how we access, manage, and interact with credit. AI and machine learning enhance credit scoring models, assess risk more accurately, and personalize credit offers. This can make credit more accessible, empowering those previously excluded from traditional lending. Blockchain technology streamlines credit transactions, reduces fraud, and enhances transparency. Smart contracts could revolutionize debt repayment, collateral, and credit agreements. Open banking creates new possibilities for personalized financial services and tailored credit products. This data-driven approach empowers consumers with greater control over their financial lives. The evolution of consumer credit is far from over. As technology advances and our understanding of financial behavior deepens, we can expect more innovative and inclusive credit solutions to emerge. Looking ahead, the future of credit. As we summarize the journey through the history and evolution of credit, it's crucial to acknowledge the ever-changing landscape that lies ahead. The future of credit is not just about new technologies, but also about creating a more inclusive financial ecosystem. The convergence of AI, blockchain, and open banking heralds a new era where credit becomes more than just a financial tool. It transforms into an enabler of dreams, aspirations, and opportunities for everyone, regardless of their financial background. As we move forward, it is our collective responsibility to ensure that these advancements are harnessed ethically and equitably. The future of credit should be one where innovation meets inclusivity, ensuring that everyone has the opportunity to build a better financial future. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.